Have you ever looked at a bill maybe for the vet and just thought, wow, that's what the law around?
No?
Or maybe you've just been puzzled by all the, the hidden details and everyday money stuff. Well, welcome to the Deep Dive. This is where we cut through the noise, try to bring you the most essential and sometimes surprising insights from the whole back. Today we're taking a deep dive into the latest consumer trends and news. This is all aggregated by consumers.app for their Consumers 360 commentary dated July 8, 2025. Our mission really is to pull out those key nuggets of knowledge from all these different headlines and explore what they actually mean for you, for your wallet, your well-being, your future.
Yeah, it's a great mix today. We've got personal finance, retirement stuff, even some pretty cutting-edge science. It really gives you a snapshot of, well, the modern consumer landscape. We'll be digging into how all these things impact your money, your plans, even your health.
Okay, let's jump right in then. Our first headline comes from NBC News via MSN.com. It says, that's a lot of scratch. More pet owners spring for insurance as vet costs climb. So, okay, vet costs are up. People are getting insurance. But there's more to it than just the cost, right? What's really driving this surge? Well, what's really fascinating, I think, is this whole idea of pet humanization.
Mm-hmm.
It sounds a bit academic, but it's simple, really.
Mm-hmm.
We're treating our pets more and more like actual family members, cherished members. And when you do that, well, providing the best care, that becomes almost an emotional need, not just a practical one.
So the emotional bond is pushing people towards insurance.
Exactly. That bond is a huge driver. People want to protect their furry friends just like any other family member, sometimes, well, almost regardless of the direct financial calculation. It's powerful.
Okay, so beyond that strong emotional pull, how is this trend actually changing things for the insurance industry and, for pet owners themselves? Right, so the rising vet costs, they definitely push more people to see insurance as like a financial safety net, a crucial one. But it also puts, real pressure on the insurers. They've got to innovate. They need to balance offering good, comprehensive coverage with keeping the premiums, well, affordable. So you see new plans, more flexible options appearing.
And you mentioned something about how we frame loss.
Yes, exactly. The loss framing effect. It's a known psychological principle. When you, as a potential customer, really perceive the risk of a big financial hit, like a huge vet bill out of nowhere, you're much, much more likely to buy insurance to avoid that potential loss.
So fear of that big bill is a big motivator.
It really is. And insurers understand this. It's especially noticeable, apparently, among younger consumers. They might be more influenced by the emotional side of facing those big potential costs. It just highlights how our feelings about potential loss can really steer our financial choices. So a question for you to think about is, how do you personally weigh that emotional investment in your pet against the cold, hard financial numbers?
That's a tough balance. Okay, let's switch gears a bit. Moving to a different kind of financial planning now. Government executive has reported on a new rule affecting retirement savings for federal employees. The headline is, Retirement Board finalizes new rule on how debt is calculated for some TSP loans. This sounds like it could be pretty significant for folks with a thrift savings plan, the TSP. What's the main change?
So yeah, the TSP, it's basically the federal government's 401k, right?
Mm-hmm.
For federal workers, military members. It's a defined contribution plan. The board that runs it, the Federal Retirement Thrift Investment Board, they've finalized this new rule. And it changes how they calculate the accrued interest on certain loans taken from the TSP, specifically when those loans are re-amortized, meaning like rescheduled.
Okay, re-amortized loans. So in simple terms, what's the impact for someone who has or might take out a TSP loan?
Well, the aim seems to be to make the repayment process a bit smoother, maybe a bit less burdensome financially. By recalculating the interest, it could potentially lower the overall cost for some participants. If you connect this to the bigger picture, it touches on, the best way to manage investments in these kinds of retirement plans when you also have loans involved.
So it might make taking a loan seem easier.
Yeah.
Or less risky.
It could subtly shift that perception, yes. It might make using your TSP funds for, say, short-term needs seem a little more appealing because the interest calculation is perhaps more favorable or at least clearer. But, of course, there's always that trade-off. The crucial thing for anyone with a TSP to think about is, how does this adjustment influence your decision? Does it make you lean more towards using the loan feature for immediate needs or stick to focusing purely on long-term growth?
It always comes back to that balance, doesn't it? Using retirement funds now versus letting them grow for later.
Precisely. Participants always face that challenge. When is the optimal time to borrow, if ever? Weighing returns you might get elsewhere against using your own retirement funds. This rule change just adds another factor into that calculation. It tries to make the loan side a bit more manageable, maybe.
Okay, let's shift gears again. Something most drivers deal with: car insurance. The Motley Fool has a guide out just called Guide to Car Insurance. How does it work? Beyond the basics, like, don't crash your car, what are some key takeaways or maybe less obvious things that really drive our premiums?
Right. So car insurance, we know, covers damage, injury, liability, also theft, vandalism, storm damage, things like that, critical protection. Now, the factors influencing your premium are numerous: age, gender, driving record, where you live. Those are the big ones people know. But what's maybe less appreciated is how much these things matter. And some other factors, too, like the specific make and model of your car. That can have a huge impact.
Oh, really? How so?
Well, it's not just the car's sticker price. It's about how much it costs to repair that specific model, how easy it is to get parts, even how likely it is to be stolen. Some cars are just targeted more often or cost a fortune to fix.
Okay, that makes sense.
What else? And then there's your credit score. In most states, insurers use your credit-based insurance score. The thinking is financial responsibility often correlates with responsible driving habits. Whether that's fair or not is another debate, but it's a factor.
I've definitely heard myths about car insurance. Like, does the color of your car really matter?
The classic one. No, generally the color of your car does not affect your premium. That's a persistent myth. Another common misunderstanding is about who's covered. People sometimes think only the person named on the policy can drive the car. But actually, most standard policies cover anyone who drives your car with your permission, though you should always check your specific policy details, of course.
Good to know. So understanding these details can help you make better choices.
Absolutely. Knowing what actually influences your premium empowers you. You can think about the insurance costs before you buy a certain car model, for example.
Yeah.
And it helps you figure out what coverage you really need beyond the basics. So a question for you is, thinking about your car, your driving, what extra coverages might actually be crucial for you beyond just the state minimum?
Yeah, things like comprehensive or collision or uninsured motorist coverage worth thinking about.
Definitely. Understanding those variables helps you shop smarter and get the right fit for your budget and your life.
Okay, next topic. This one causes some anxiety for people heading towards retirement. SFJ asked the question: would you lose Social Security benefits if you sell your home after retirement? This feels like a big worry for some folks. What's the quick answer? Can we put minds at ease?
Yes, let's try. The straightforward answer is no. Selling your home, your primary residence, does not directly cause you to lose your Social Security retirement benefits. Your Social Security benefits are based on your lifetime earnings, your work history, how much you paid in. They aren't based on your current assets, like the value of your house or the cash you get from selling it.
Okay, that is a relief. So the core Social Security benefit is safe from the house sale itself.
Correct. That specific link isn't there. The proceeds from selling your home are not counted as income for Social Security retirement benefit calculations.
I sense there might be a but coming. Are there other financial things to watch out for?
There are, yes. It gets a bit more nuanced. While the Social Security benefit amount isn't directly cut, selling your home could have tax implications, and those taxes could indirectly affect how much of your Social Security is taxable.
Ah, okay. How does that work?
Well, if you sell your primary home and have a large capital gain, that's the profit, there's an exclusion. It's currently $250,000 for single filers, $500,000 for married couples filing jointly. But if your profit is above that exclusion amount, the excess gain is generally subject to capital gains tax. Now, that taxable gain adds to your overall income for the year. And if your total income goes up, it can push more of your Social Security benefits into the taxable range. Up to 85% of your benefits can be taxed depending on your total income.
Right, so the house sale itself doesn't cut benefits, but the profit could increase your overall income, which then makes more of your Social Security taxable.
Exactly. It's an indirect effect, but an important one to plan for. So the question becomes, how are you strategically planning for potential capital gains tax if you sell a major asset like your home in retirement?
Good point. And what about other types of benefits? Not Social Security retirement, but maybe other programs seniors will rely on.
Yes, that's another crucial consideration. Selling your home could definitely impact eligibility for what are called means-tested benefits. These are programs where your eligibility depends on having income and assets below certain limits.
Like Medicaid, for example.
Medicaid is the prime example, yes. Or supplemental security income, SSI, though that's different from Social Security retirement. If you sell your home and suddenly have a large amount of cash from the sale, That cash counts as an asset. It could push your total countable assets above the limit for Medicaid or similar programs, potentially making you ineligible at least for a while.
Wow. Okay. So it's really important to get advice before making that move.
Absolutely essential. This highlights why talking to financial advisors, tax professionals, maybe even an elder law attorney is so important. They can help you understand the full picture and manage the proceeds strategically, maybe reinvesting in another home or using other financial tools like specific trusts.
Okay. Super important nuance there. Let's move to our final topic, which touches all of us: brain health and aging. Neuroscience News has a headline that definitely makes you think. How fast your brain ages could determine your future health. What's the core idea here? Is it really that predictive?
It's a powerful idea, and the research is increasingly backing it up. What's really striking is the direct, profound link scientists are finding between the rate of your brain aging and your overall health trajectory. We all know our brains change as we get older structurally, chemically, functionally, even down at the level of single neurons. That's expected.
Sure, memory slips, things like that.
Right. But the deeper insight here is that these brain changes aren't happening in isolation. They are deeply connected to the risk and progression of major neurodegenerative diseases like Alzheimer's, Parkinson's, ALS. But it goes beyond that. The health of your brain seems intertwined with your risk for heart disease, diabetes, other systemic conditions. Aging isn't just, a passive risk factor. It seems to be an active process influencing how these diseases develop throughout the body.
So the speed your brain ages isn't just about cognitive decline. It's like a bellwether for your whole body's health.
That's a great way to put it, a bellwether. Think about this emerging concept of the brain-heart-eye axis. It sounds a bit like science fiction, but it's based on real data. Researchers are using advanced imaging of multiple organs combined with genetics and proteomics. That's the large-scale study of proteins, which tells you a lot about what's actually happening in your cells.
Okay.
And they're finding these deep connections. For example, something called endothelial dysfunction, basically, when the lining of your blood vessels isn't working properly, leading to things like inflammation and oxidative stress. Well, that dysfunction is a common thread linking brain aging, heart disease, eye conditions, and even severe infections like sepsis.
Wow. So problems in the blood vessels could impact the brain, the heart, the eyes. It's all connected.
Very much so. And understanding these cross-organ links, these axes, could be revolutionary. It could help us predict who's at risk for cognitive decline or systemic diseases much, much earlier than we can now, maybe even before symptoms show up.
That sounds incredibly promising for future medicine. Potential for prevention, new treatments.
Absolutely. The potential is huge. Research into how gene expression changes in aging brain cells, identifying genetic factors that influence aging across different organs, this is all paving the way for potential rejuvenating strategies. And things like cross-organ disease modeling, using computers to simulate how a problem in one organ, say the heart, might affect the brain over time, that offers immense possibilities. It could improve disease prediction, help tailor treatments, maybe even find new uses for existing drugs to tackle these complex, interconnected chronic conditions. It's really about shifting towards a more holistic, integrated view of health and aging.
What an incredible range of topics today. Seriously, from figuring out pet insurance because we love our furry family members, all the way to the frontier of brain science and how it connects to everything else. It's just so clear, isn't it? These consumer trends, financial rules, scientific discoveries, they're not just abstract things. They're deeply woven into our everyday lives and our long-term well-being.
Definitely. Each of these deep dives, pulled together by consumers.app, really gives us a unique lens, a way to look at the world and hopefully make smarter, more informed decisions about, well, everything. Our money, our health, even how we care for our pets.
Well, thank you so much for joining us on this deep dive. We really hope you found these insights useful, maybe give you something new to think about. And before we wrap up, here's that final thought we left to you. In a world where information is just constantly changing on everything from pet care to brain aging, how might our ability not just to get new knowledge, but actually adapt, integrate it into our lives, how might that ability ultimately define our quality of life in the years ahead?